Joining us now in studio today, Sam Radwan, President and CEO of Enhance International. Sam, great to have you here in person to take a closer look. The data that we got out of China last night was not great. Retail sales contracted for the first time since the end of their zero COVID policy. And you were in China recently. Is confidence really as low as the data makes it seem?
Not only is it low, but it is long term. Okay, it is systemic. It is not something that you're going to see getting resolved this year or the year after. What you have is the National Bureau of Statistics comes out with a consumer confidence report. We have tracked that report for over 15 years, and it is not a good reflection of really what's going on. So we came up with our own set of indicators. So there are major indicators out there that you can look at, like the 10-year, like birth rate, like home prices, other variables in a similar fashion, like savings rate. So, for example, savings rates has doubled since 2021 compared to where it was a decade before, right? So those indicators are, in our view, a lot more indicative of what's going on. And back to your point, all of them are trending negatively. So that's the answer, which is yes, this is real, this is systemic, this is long term.
So if the government data out of China isn't showing, as you say, reflecting what's actually going on, as you look at your own consumer confidence index, what does it include? What metrics are standing out to you most, other than those ones that you just highlighted there? And what is the differential that it's showing between the data that we're getting reported by the government and what you're actually seeing on the ground and looking through the metrics you're focusing on?
Okay, well, one big indicator, I have to say, is home prices. Okay, the big difference between China and the U.S. is in the U.S., an average of around 1% to 2% of households own more than one home. In China, it's 20%. That second home is your 401k nest egg, right? So when you look at home prices, you're not just looking at the value of your home where you dwell in. You're looking at the money that you're saving for retirement and a rainy day. And that number is relentless. There is no way to turn it around. And that is a very big indicator of what are things to come. Number two is you have to look at, and we're learning more and more about the Chinese consumer and how they think, which is somewhat different than the U.S. consumer. They think very long term, right? When you talk to a young lady who's just graduating from college, who is trying to understand what her future will look like, she's already trying to plan out to see whether marriage is really worth it, whether having children is really worth it. They're thinking for the very long term. So you're not going to see a lot of fluctuation. That's why we believe that this point of view is going to be there for the long term. And that's why you're seeing birth rates the way they are right now.
And so if Chinese consumers are watching their wealth deteriorate in the property sector and you're seeing those issues there, how are they looking at investing in the markets?
They are looking at it from a standpoint of, yes, there are opportunities, but then what's happening right now is if you look at the market, it's not necessarily the mainstream method of investment as you do here in the U.S. This is not where you're going to put your retirement money. This is where you are going to take some of the money that you have extra and you're going to gamble with it a little bit in the market, right? So if you look at the overall market in China, it's trading at around 10% PE, which I think is reasonable. But then you start looking at the AI stocks. They're trading at 60 to 70 times PE, right? So there's a lot of speculation going on there. And to your point, it's not necessarily that type of money that you think of in terms of this is the money that I'm going to use for a rainy day.
And so as you highlight those AI stocks and some of those PE ratios, are you viewing China AI stocks as being in a bubble? Because certainly when we start to get numbers that seem that high, that's the conversation that comes up.
Well, recently there have been some intervention by the regulators, which I think is positive, right? And they're really trying to stem the tide in terms of those areas where they believe are truly going to cause a lot of problems. And I think the market reacted positively to that. So, yes, you can make an argument that there is definitely a bubble from that particular perspective, but I don't think it's going to burst anytime soon. It more or less follows the NASDAQ, right? They look at what happens in the U.S., and it tends to follow in that direction. So if you see a correction in the NASDAQ, you're more than likely to see a correction in the Chinese AI stocks.
And let's talk about policymakers here, too, and come back to property, because I was noticing there are some signs of stabilization in some of the big cities that are tied to AI investment. How challenging of a setup does that make for policymakers, where we're seeing this sort of uneven stabilization?
Yeah, one thing that the Chinese government is very proud of, and I would tend to agree very much, is they have been able to lift the entire population from poverty, right? But I think that's about to change. You're getting a bifurcation in the economy, where you've got the old economy or the real economy. I'd rather call it the real economy. And then there's the digital or the new economy, right? Those are booming. And the cities that are supporting that, like Shenzhen and Guangzhou and Beijing and Shanghai, they are booming. But take a traditional city like Nanjing, for example, the old capital of China during the Ming Dynasty, right? That is doing very, very poorly in terms of the performance of the market. So people tend to look at Beijing and say, okay, if that market is stabilizing, right, then everything else is going to stabilize. But that's very far from the truth. Tier 3 cities, for example, are in very, very bad shape.
And so how much does Beijing's focus on national priorities and sovereignty limit its ability to pursue more aggressive economic growth policies?
I don't think it's just so there are two sides to this, right? And there are two areas that President Xi talked about. One is production and exports and the new economy, right? And I think the government's going to do a good job from that perspective. But what they're missing is they need to find buyers, because those buyers are not there in China. They are outside of China, and they are the bigger markets where there's tension. Right? So in my view, this ultranationalistic government is going to prioritize national issues, right, compared to that. So we're going to see whether we're going to hit a ceiling or not. The other part is the Chinese government is going to learn very, very soon, right, that they're not going to be able to change the behavior of 1.3 billion people, right? Welcome to the free market. You know, this is something that they're just going to have to now deal with. So, for example, if you take a look at retail spending, for example, during Chinese New Year, they were able to put incentives in there, and you saw, you know, a pretty healthy number in terms of that month. And now you're seeing it coming down by gravity very fast.
Sam, we sadly have to leave it there, but I so appreciate you being in studio with us today to take a closer look at the Chinese economy. I know that our Sam Vadas, will be sad that she was off today, because she never misses an opportunity to discuss China, and I know she's a friend of yours as well. But really appreciate you taking the time to be with us today. That's Sam Radwan, the president and CEO of Enhance International. And coming up,